Namaste, welcome to Arthaniti, where we discuss money and money related tools to help you in your everyday investment decisions. My name is Dr. Shefalika Gokhale, and I am a PhD in business practices of mutual fund houses. Today, let us discuss about investing prospects in Indian banks. We will start with the history of the Indian banking system, looking at some turning points in specific times in history. We will then concentrate our attention towards public and private sector banks, and then lastly weigh in on the pros and cons of reaching at an investment decision of whether the Indian banking industry is a suitable investment option in current times. Indian banking journey has been long and storied, but major turning points happened only post independence. In the 1960s, where banks were nationalized, was one of the major turning points in banking journey. The reason for nationalization was to make the banks stable and reliable. This was followed by the privatization policy adopted by the government in 1990. It saw many private sector banks open shops in India and bring faster and technologically savvy banking operations to the Indian market. It was followed then by the 2008 Lehman Brothers crisis, but thankfully the Indian banking system weathered that storm well thanks to domestic loans that were predominantly given by our banks and a strong regulatory framework. Near in the like last few years, we have seen similar crisis happening in China with its real estate giant Evergrande for facing liquidity crisis and putting pressure on the Chinese banking system. Last month, Vietnamese real estate major also declared liquidity crisis, but no such crisis uh, came to Indian shores thanks to the robust regulatory network, regulatory processes that we have in place in India. Indian banking sector is predominantly a two-horse race. Public sector and private sector banks, well, cooperative banks also have significant share in the banking system. When it comes to public sector banks, the government owned institutions, SBI is one of the largest banks in the country with the largest branch network around the country. But public sector banks are marred with operational inefficiencies and slow growth. Turn to private sector banks, HDFC Bank, ICICI Bank, Axis Bank, Kotak Bank are a few names in the private sector space. ICICI Bank is the largest private sector bank in the country. HDFC Bank, with its recent merger with HDFC, only future will tell how this merger pans out and how HDFC Bank comes out from the initial hiccups when two entities have now merged. Let us look at the pros and cons of this industry and study them to reach at a decision whether this industry is a prospective investment gateway. Now, Fitch Ratings has come out with a positive rating for Indian banking sector for the year 2024. According to Fitch, Indian banking has particularly performed well in the year 2023 in the Asia Pacific emerging markets region. I'm sorry. They basically attribute this good performance to robust internal mechanisms and resilience of the Indian banking industry to the ups and downs in the market. Indian banking sector has always been a key player in the economic development of the country. Given the robust figures that we have recorded in terms of GDP growth, 8% for the previous quarter, it is well within limits to say that given the good economic results, it is surely going to spill over to the Indian banking sector as well. Why? Because it is one of the key players when it comes to capital allocation, uh, disbursing capital to the industry, risk management, and promotion of financial inclusivity, like more and more people coming into the banking system. The health of the banking system can also be judged by the reduction of the NPA, non-performing asset ratio of this sector, from a high of nearly 11.9% in 2018. It has come down to 3.9% in 2023. This only shows improved financial health of these banks, and with the reduction of non-performing assets uh, that these banks have disbursed. RBI, one of the foremost renowned central banks in the world, has done a fantastic job with stringent regulations which ensure transparency and stability to the Indian banking industry. These being the plus points, one should never ignore or overlook the cons or the risks that are involved in this sector. Look out for interest rate swings as central banks uh, r- like go on a reduction of interest rates, like enter the reduced interest rate cycles. It will affect the bank's profitability. Generally, with lowering of interest rates, bank stocks also tend to go down. So you have to look out for any interest rate decisions that the central banks take. Secondly, too many loans and not enough repayments can be a situation, especially when it comes to unsecured loans like personal loan kitties of these banks. Central bank has cautioned the banking system against a rampant disbursement of unsecured loans, which are a great credit risk to the Indian banking industry. Look out for these points. So, is now a good time to invest in the banking sector? Well, here, like I went through a report by DSP Mutual Fund, and they have cited an interesting finding. The Nifty index did exceedingly well in 2023, but in comparison to the index, the Indian banking stocks have not performed that well, but their valuation seems attractive. According to this DSP report, it says that historically, whenever the Nifty Bank Index price to book value (PB) price to book value ratio falls below 2, investing in the banking sector has led to good returns in the following years. So, in Jan 2024, as per this DSP Mutual Fund report, the PB ratio of banking stocks has fallen below 2, which makes these stock valuations attractive investment option. What this report states that historically, when this ratio has fallen below 2, these stocks, when you invest in these stocks, when this ratio is below 2, it has given good returns in the following years. A little explainer: what is price to book value ratio? Um, Say, for example, you are preparing a pizza. Now, the cost of all the ingredients that you use to make that pizza form the book value of your pizza. What is the price? Price, on the other hand, is the value the customer is willing to pay for your pizza. Right? Looking at how you have prepared the pizza, the packing, the taste, the quality of the ingredients, the customer, if he values your pizza more than the cost that you have incurred, yes, the PB ratio goes above 1. In case the PB ratio falls below 1, it is said that the stock is undervalued and looks as an attractive investment option. So, a small explainer about what PB ratio is. Now, you should be able to understand the DSP report and the findings that I told you. So, the final question: If you plan to invest in the banking sector, what are the different ways? Firstly, you can buy individual banking stocks, but again, you have to research well and it is a lot more riskier. Secondly, you can invest in mutual funds that invest in banking stocks, correct, wherein your risk is distributed amongst all the investors like you who have invested in that mutual fund. Thirdly, you can invest in a bank ETF where like the it offers less control than any other option, and it is a convenient way of investing in banking stocks, correct. So I hope this video has given you, if not full, a little insight into the Indian banking sector and why it is looking promising, given all the Fitch ratings and the DSP mutual fund report and the various factors plus the risks that we saw in this video. Please take informed decisions, read about the sector. The more the better. If you have any queries, please feel free to comment below this video and I will be happy to answer your queries. I hope you have liked my video. Please hit the subscribe button, like the video, and look out for more such videos which will give you insights into your investment decision making process and help you reach a better investing decision. Thank you. Until next time. Goodbye.